Hello and welcome to our special session today on Target Maturity Funds brought to you in association with Mirae Asset Mutual Fund. I'm your host Gautam Srinivasan. Well, to set the context, central banks around the world have been increasing interest rates in a bid to curb high levels of inflation. Now, India has been no different, with the Reserve Bank of India increasing the repo rate by 50 basis points to 5.90%. India's benchmark 10-year bond yield that also rose to 7.5%. So, in an environment where interest rates are at an all-time high, investors are looking into lock these rates by investing into target maturity funds, which are essentially open-ended debt funds with a specific maturity date. At the time of maturity, the principal and interest are both paid out to the investor. So, one of the biggest attractions towards an investment in target maturity fund that lies in the predictability of its returns. As an investor, you sign up for a fixed tenure, and if you hold the funds till maturity, you can expect to get the indicative yields, which in effect works like locking in the returns being offered in accordance with today's interest rates. Target maturity funds also serve as a great tool to diversify your portfolio by making some addition of debt to it. However, it is imperative to time the investment right in order to maximize the portfolio returns and also stay invested for the full term. Being open ended funds, they offer the benefit of an early exit, which could prove to be counterintuitive. So, to get a complete picture of target maturity funds, who they are best suited for, and what portion of your portfolio you should invest into them, I'd now like to introduce our special guest for today's discussion, Mahendra Kumar Jajoo, CIO for Fixed Income at Mirae Asset Investment Managers India Private Limited. To speak a bit about Mahendra, he's responsible for supervising all debt schemes of Mirae Asset Mutual Fund, and he has over 29 years of experience in the field of financial services. That includes 15 years of experience in fixed income funds management. Always great to have you on board, Mahendra. And this looks like to be a wide ranging conversation that is rich in content and experience. So let's start by understanding the very basics. What are target maturity funds? If you can kind of explain and dissect it for our audience.
So, first of all, thank you for inviting me today. As you described in your introduction, target maturity funds are the funds which aim at investing for a specific maturity date. So, let me just talk with an example. Let's say there is a target maturity index fund with the maturity date of 31st December 2027, which means that all the investments in the fund will be focused towards having a co-terminus maturity along with the fund target date of 31st December 2027. So in no case, any of the securities that the fund will invest in will have a maturity greater than 31st December 2027, which means there is no possibility of a maturity mismatch. The second is that overall duration and the maturity of the portfolio has to be in line with the target maturity date. Therefore, no security will have a maturity more than 1 year before the target maturity date. So, because at times it is not possible to make exactly match maturity, so largely the target maturity of the fund is the range of the maturity in which securities the fund will invest in. The second aspect is that the fund will be investing in line with a certain index which it will try to replicate. So to that extent is it's a bit of a passive investing, and therefore the investors will have a much better awareness and information on a transparent basis in terms of what the portfolio composition will be. So let's say again in our example, if this fund was a 5 year SDL index fund, which means the index will have state development loans, then all the investments of the fund will be with an objective to replicate the index, and therefore all the securities in the portfolio will be state development loans unless there is no availability then for short term purposes. So for all practical purposes the fund will have only state development loans. So the investor will have a much higher confidence about the composition of the portfolio, not only at the time of the launch of the product, but during the whole tenure of the fund. He will have a complete awareness about the maturity matching of his investment horizon and the securities in the fund. And finally, because the portfolio yield is known to the investor at all times, he can have a much better predictability of the eventual return that the fund will give within a narrow range if he chooses to remain invested till the maturity of the fund. So typically the investors are concerned about two factors when they invest in debt funds. One is that whether there will be dip or a negative impact on the NAV if the interest rates go up, or whether they will have volatility in terms of the credit in the portfolio, and what kind of returns the fund will give over its investment horizon. So all the three major factors that the investor is trying to ascertain at the time of investing are available to him with a much higher degree of confidence in target maturity fund, and which is why I believe target maturity funds are becoming very popular nowadays with the investors.
All right. And expanding what you said, how are they different or similar to other open ended debt funds? Because you mentioned about that investor confusion. So if you could clarify some points on this regard for all of our viewers.
So there are in all about 16 categories of debt funds which SEBI has allowed. Each fund is based on either a range of duration within which that fund can invest, or the kind of credits it can take. So, if you take an example of the short duration fund, the SEBI has allowed in its guideline the duration range of between 1 to 3 years in that fund. So, depending on how the fund manager assesses the situation, what kind of a PRC metrics he has chosen, the fund can have a duration between 1 to 3 years at different points in time. The composition of the portfolio can be very, very diversified. Uh, the requirement is for the overall portfolio duration to be between 1 to 3 years, but the fund manager may choose to invest in a 10-year bond or just invest in 1 year bond. So, for the investor, while he knows the overall duration range, the attribution or the impact of the different composition of the portfolio may not be what he is expecting, how he understands in the work functioning of the short duration fund. Whereas in case of a target maturity fund, it is more like an FMP, where most of the investments are aligned with the maturity date of the fund. It is more like a bank fixed deposit, where if you invest for 5 years, at the time of investing, you know what rate of interest the bank is going to pay, what is the frequency of the compounding of interest, whether it is quarterly, half yearly, annual, and you know the terms of redemption. If you want a premature payment of the bank fixed deposit, you know the terms in advance. So it works more like a bank fixed deposit or a fixed maturity plan. Therefore, the as I said in my earlier comment also, the investor has a lot more certainty about what kind of a portfolio he will see during the life of the fund, what is the type of security that he will find in the fund, and what is his expected return with a reasonable certainty within a narrow range. Now, all these three factors are not available to the same extent in an open-ended debt fund, and therefore the uncertainty factor associated with those funds is higher, and therefore the different funds have their different utility or usefulness for different types of investor, and therefore if someone is investing with a specific goal, with a specific target return in mind, or with a specific quality of the portfolio in terms of the credit, then a target maturity fund will serve its purpose with maximum efficiency as compared to an open-ended debt fund.
All right. Looking at the comparisons that you've just made, I also want to know more about how the investment philosophy for target maturity funds is different from, say, a similar tenure fund, right? If I had an example, say, how is a target maturity fund investing in 5 year maturity funds? How is it different from a short to medium term fund, which is of similar tenure?
So, A short duration fund for that matter has a duration range of 1 to 3 years. But let's say there is, as I said, these are cheese and chop that we're talking about. An open-ended fund provides a lot of flexibility to the fund manager in terms of how the portfolio is constituted, what kind of different maturities are there in the fund, and what kind of market volatility or uncertainty can impact the functioning of the fund. Whereas in case of a target maturity fund, those uncertainties are to the minimum extent. Now, let's say if you have two funds which have the same 5 year maturity, average maturity, for example, there is something that we describe in the fixed income world as a barbell strategy, and then we have something called the butterfly strategy. So, just to give a better description in terms of the visual perception to the audience, a barbell is like when we go out for work, to the gym, we have these weights where you have a rod in between and then you have the weights on the two sides, so that is a barbell. So most of the weight is on the ends of the equipment, and in between it is a thin rod which we use to lift the weights. So if it's a barbell portfolio, it may have a 5 year duration, but it may have 50% investment in 10-year bonds and 50% it may have cash. So the average maturity will, on an approximate basis, work out to 5 years. And then there is a butterfly strategy. So as we know, the butterfly, most of the weight of the butterfly is in the central body, and then the wings have hardly any weight. So it is the reverse of the barbell. So in case of a target maturity fund, which is again 5 year, all the investments will be by and large 5 year maturity. Then, in case of a target maturity fund, the need for continuous change in the portfolio is not there unless there is an inflow or outflow. And again, if there's an inflow, you invest more in the same maturity. If there's an outflow, then you have to sell and create liquidity for paying the redemption. Whereas in case of an open-ended fund, the fund manager has the uh, where is in case of an open-ended fund, the objective of the fund manager is to outperform the index. In this case, the objective of the fund manager is to replicate the index, and therefore his need to be active and generating alpha is not there. So this is a passive investment where the investment strategy is directly replicating the index, and therefore giving a far higher certainty, clarity, transparency, and assurance to the investor in terms of how, during the life of the fund, the investments will be of what maturity, what credit quality, what category of the debt, whether it is central government bonds or SDLs or AAA PSU or whatever is in the index. As of now, almost all of the target maturity funds have investment uh, conditions only in the central government bonds or the state development bonds or in AAA PSU bonds. So there are, I think, significant differences. And for the purpose of this discussion, therefore, I think a better comparison will be between a fixed maturity plan versus a target maturity fund, or between a bank fixed deposit and a target maturity fund, because those are the kind of investments which are more passive in the nature in terms of the strategy of the fund. And therefore I think, if I were to summarize in one sentence, I think open-ended funds are for the investors who are looking to generate higher returns with a little bit of the volatility and play in terms of duration and credit in the funds. The target maturity fund is more like a bank fixed deposit or fixed maturity plan in terms of its basic character, where the objective is to provide maximum clarity to the investor in terms of the uh, investment maturity, the quality of the portfolio, and the expected return at the end of the horizon of the fund.
Right, Mahendra. Now, considering its passive nature, I also want to understand from you, what sort of investment experience can an investor in target maturity funds expect in comparison to, say, an active managed fund?
Now, as I said, that the basic difference is between the uh, certainty or the higher probability with which investor can work out his eventual exit returns, etc. Because in this case, because it is passive, it will replicate the benchmark. Unlike the other asset classes, here there is a certain fixed maturity on which they, irrespective of what happens in between in the market, the bonds will mature at the yield at which it has been bought. So I think the basic difference between the actively managed fund and the passive managed fund is the predictability of the final outcome. That's the more important part. Therefore, in case of an active management fund, the investor will expect the fund management to outperform the benchmark through his investment expertise. Whereas in this case, the investor will expect the fund manager to be able to replicate and generate the same return that the benchmark has generated. So it's a classic active versus passive as we have in case of equities.
All right. And for all of our viewers, what portion of a portfolio can be invested in target maturity fund? Looking at the different needs, different profiles, take us through, how much of a part of a portfolio can target maturity funds actually constitute for our viewers?
So again, as we have discussed in some detail as to what is the difference between an active fund and a passive fund, an actively managed fund and the passively managed fund, uh, it would depend on the objective of the investor. It would depend on the investment horizon of the investor. It will depend on the risk preference of the investor, both in terms of the volatility and in terms of the credit spread that he wants to look at. So it is not possible to give one line answer or a specific number in the absence of understanding the risk profile and the investment objective of the investor. And there are experts and investment advisors who can work on these numbers, but at a very general level, the primary objective of the investors in debt is to basically look at a stable, predictable, and safer kind of a return profile. And we have seen in our country that a huge, overwhelmingly large proportion of the fixed income investments are either in the bank fixed deposits or in single premium insurance products and so on. So that reflects the investment preference of the investors. And as the capital markets grow, as the different new offerings are available to the investors, they will migrate from the traditional channels into the newer and more contemporary products. So target maturity product basically caters to that range of investors. We used to have the fixed maturity plans, and I think broadly speaking, target maturity funds are significant improvement over the functionality of the fixed maturity plans. Three major improvements I will just like to touch. One is that the target maturity funds are open-ended fund versus the fixed maturity funds which are closed-ended fund. The difference is that if one is looking at a fixed maturity plan, then on the NFO closer date at the last, he has to decide whether he wants to invest or not. So there may be, for example, investors today who believe that interest rates will go up higher from here. They want to take advantage of that, or someone may not have the cash flow on the date the FMP is closing. In this case, it's an open-ended fund, so the investor can track the portfolio, he can track the fund, and on the day he has the liquidity or the investable surplus, or he likes the market yield, he can invest on that day. So that one flexibility is there in this product, which is not available in a bank fixed maturity plan. So it's more like a bank fixed deposit where you can just walk into the bank, and if you like the rate that day, it matches your investment horizon, you can invest. The second difference is in terms of knowing the portfolio. So in case of fixed maturity plans, at the time of the investment, the investor has, I mean, little to no idea about what the portfolio will look like, because under the current guidelines, it is not allowed to indicate the portfolio. And contrary to that, in case of target maturity fund, because it is going to replicate an index, investor will have complete information about what the portfolio of the fund is going to be at the time of investing and through the tenure of the fund for the rest of the life of the fund. And finally, in case of a fixed maturity plan, because it is a closed-ended fund, investor cannot exit from that fund except by way of selling in the secondary market, where from the current experience we can say that the liquidity is practically next to zero. Whereas in this case, these are open-ended funds. In case of an emergency liquidity requirement for whatever reason, the investor can still get out by putting a redemption request. So these are three very potentially high impact features which are available
Hmm.
in target maturity funds. And then on top of it, it gives a FD like predictability of the returns within a narrow range, in a multi-sigma event, maybe that is not achieved, but by and large, I think one can expect that to happen. So it's a very simple, intuitively very easy to understand, transparent product, and therefore, uh, if you map the basic construct of the investor's psyche in the Indian debt market, then obviously a reasonably large percentage of his portfolio will naturally get allocated to that. Now I just want to make a very important distinction, because like in the equities market today, we have a huge debate on active versus passive. And here also, my sense is that it is not at the cost of active that this product will get more traction, but because there is a huge constituency which is only investing in bank fixed deposits, either due to lack of awareness, or because of lack of familiarity, or because of lack of confidence, or because of the lack of the predictability of the portfolio and the return. And that is the segment which would, over a period of time, as they understand it better, will move here. And so without giving a number, I would say that, as I see it, increasingly a fairly large component of the investor's portfolio will be allocated to the target maturity fund.
Absolutely. Recapping some of the points that you've mentioned around, say, flexibility and predictability, going beyond that, what are the advantages? And to give a complete picture, the disadvantages in target maturity funds for all of our viewers.
Well, there is no free lunch, so there are advantages, there are disadvantages. uh, Advantage, of course, is the predictability of the composition of the fund portfolio, the final return, etc. That's the same thing is a disadvantage also, because the traditional wisdom is that the longer your investment horizon, the better your ability to absorb volatility, the higher would be the return, because markets are cyclical in nature. Of all the markets, the interest rates are the most cyclical in nature. Interest rates are one area where there is a strong oversight by the central banks. Central bank's preference is always for a smooth conduct of the market, possibly for a softer interest rate regime as we have seen in the recent years. And therefore, the debt funds, through the volatility, if someone has the patience and the stomach to sit through a complete interest rate cycle, can provide strong capital gains and possibly higher returns. So, the advantage of the target maturity fund is the predictability and certainty, whereas the disadvantage is that if you invest in target maturity fund, there is no upside, right? In case of an actively managed fund, there is an upside possible if the investor encounters a favorable interest rate cycle, then he can make returns which are significantly higher than the target maturity fund. So this, I think, is the primary advantage versus disadvantage. Beyond that, I don't think there is any significant advantage or disadvantage between the two categories, active and passive. It's basically the investment objective of the investor and the investment horizon which determines whether he should go for target maturity or actively managed fund.
Absolutely. It's always about balancing expectations and, more importantly, knowing your investment goal so that you can approach the right investment product which syncs with your goal. Well, on that note, it's time to wrap up our discussion for today. Thank you so much, Mahendra, for joining us and sharing your insights and views on why target maturity funds are a great investment tool in today's times of high volatility. I would also like to thank Mirae Asset Mutual Fund for partnering with us for today's session. Till next time, this is your host, Gautam Srinivasan, signing off. Have a great day, everyone.
Thank you for inviting me today. Thank you.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.